Welcome to another portfolio update, where I show you all the trades I make using my WealthSimple trade account. In this video, I'll be buying 6 high-growth Canadian dividend stocks. Let's jump right in. The first stock I'm looking at is Allied Properties. To me, this is a very undervalued stock with a lot of growth potential. Before the COVID-19 stock market crash, this stock had grown over 170% in the last 10 years. Over its lifespan, it has shown consistent growth, a great dividend at 4+% yield, and it's an 8-year dividend aristocrat. To me, this company is undervalued and trading at a high discount. It's trading 35% below its pre-pandemic high. Its dividends are sustainable. It's managed its payout ratio well. And to me, there's a ton of more growth to come. So we're looking for Allied Properties. So you can see right now it's trading at $41.29. It has a market cap of just over $5 billion, a PE ratio of just over 10, earnings per share at 4, and a dividend yield above 4%. If we look at the stock chart, over the last 1 year, it's grown at 17%. And since 2008-2009, it is up 100%. Here we can see that it was up 196% just before the COVID crash. So to me, there's a lot of room for growth. Looking at some stats, it has a 90% profit margin, a 52% operating margin, an 8.4% return on equity. Although its quarterly revenue is down because of COVID, I'm sure it's going to go right back up once we pass COVID-19. It has a 41% payout ratio and a yield of 4%. It has an operating cash flow of $356 million and a free cash flow of $262 million. Looking at some historical data, I want to focus on the dividends. It's currently paying a monthly dividend of 14.2 cents. And this dividend has steadily grown over time at 11.8 cents 2014, and if you go 11.3 cents in 2013. So it is growing its dividend, and it's also a monthly dividend payer. Look at the financials. COVID-19 has definitely had an impact on their revenue, but if we look to 2017, that revenue was on track to grow. And I'm sure once we get through COVID, this revenue is going to continue to grow. If you look at the cash flow, to me, this is one of the most important statements you can look at as an investor. And the key line I'd like to look at is free cash flow. It has plenty of free cash flow, and it's grown its free cash flow. And here we can see the dividends being paid out increasingly over time. And 8 out of the 11 analysts that cover the stock have a buy rating. Let's go ahead and make our first purchase, being Allied Property. AP.U1 is the one we want. It's trading right now at $41.56. It's still recovering from its peak before COVID hit, so it's still pretty undervalued in my opinion. And we can see that it has a yield of 4%, a market cap of $5.26 billion, and it engages in urban office space. So I'm going to go ahead and pick up 1 share as I'm just starting a new position in this. Let's go ahead and buy AP. Don't show this again. And place the order. Done. The next stock I want to talk about is OpenText. I'm a big fan of this company. It seems like this stock continues to grow no matter what the market throws at it. And there were days when other tech stocks were dropping, and this stock maintained its growth. Plus, it pays you dividends along the way. There's not many Canadian tech stocks where you'll find both capital appreciation and a healthy dividend growth. So to me, in a Canadian landscape where there are very slim pickings in the tech space, this is one of the core holdings you can add to your portfolio. It has a very strong balance sheet. Adjusted EBITDA was up 13.8% for the quarter. Operating cash flow up 36% year over year. Their cloud-based subscriptions were up almost 40% on a year over year basis, and revenue is up almost 9%. So it has healthy growth and room for growth. It's currently trading at $59 a share. It has a market cap of $16.3 billion. It has a very high PE ratio at 180, which is pretty normal for tech stocks. Earnings per share at 0.33, and it has a forward yield at 1.7%. So unlike Allied Properties, where you see a higher yield, slower growth, what you get with OpenText is a lower yield but higher growth. Since its lifetime, it's up almost 2,000%. That is crazy growth. And if you look at just in the last year, it's up 30%. And if we zoom back out, you can see that it's been paying dividends, and healthy dividends, growing dividends. There was a split right here that have grown while the company has also grown. Looking at some stats, a profit margin of 2.73%, and an operating margin of 20.66%, return on equity at 2.26%. And although this payout ratio shows it at 219%, this to me is inaccurate, and I'll show you why. It has quarterly revenue growth of 10.9% and a very healthy EBITDA of over $1 billion. It's had 3 stock splits, 2003, 2014, and 2017, which is great if you're a shareholder because, for example, if there's a 2-for-1 stock split, let's say if you held 1,000 shares of this company and a 2-for-1 stock happened, all of a sudden now you own 2,000 shares, albeit they would be at half the price. But as that stock continues to grow, so will your shares. And if you were to look at the dividends, again, a very healthy dividend grower. Currently, it's at 25.4 cents, and it has grown tremendously since 2013. Looking at the financials, the revenue has also grown from $2.3 million in 2017 to over $3 million in 2020. The gross profit also grew from $1.5 million to over $2.1 million in 2020. It has a very healthy free cash flow at roughly $360 million in 2017, all the way to over $1 billion. So it has ample free cash flow to continue paying its dividend. And as this free cash flow grows, so will its dividend. As of February, all 7 analysts that cover the stock have a buy rating, and it's consistently had a buy rating since December. Let's go ahead and make our next purchase, Open Text. Trading right now for $60.48. And you can see it has a pretty good track record over the last 5 years, up 85%. Small yield, but again, we're not buying this for the big yield, we're buying this for the dividend growth. Has a market cap of about $16 billion. So let's go ahead and make our first purchase. New position, 1 stock. Let's go ahead and buy Open Text. And that's Open Text. Next stock up is Empire. This is another great contender, especially if you're looking for a strong defensive play with a lot of growth potential. As COVID-19 raged throughout the world, all grocery retailers got a major boost. Shares of Empire, which owns brands like IGA, Sobeys, and Farm Boy, have increased 50% year over year. Not only that, but their same-store sales are also up from the previous year at 10%. They also posted huge major e-commerce sales, which are up 315% year over year. The company has posted great earnings and pays a great dividend, which I'm sure will continue to grow as the company expands and grows its operations. Let's go ahead and check out Empire. The company is currently trading at $39.26 with a market cap of $10.5 billion, PE ratio of just under 15, and a 2.62 earnings per share. It has a yield of 1.34%. And again, this is in the same basket as OpenText, small yield, but a growing dividend. It has a profit margin of 2.49% and an operating margin of 4.58%. It has a payout ratio of less than 20%, so there's ample room for it to continue growing that dividend. The last stock split was back in 2015, which was a 3-for-1 stock split. It has revenue of $28 billion, a quarterly revenue growth of 9.7%, and a quarterly earnings growth of 46%, and a very healthy operating cash flow and a leveraged free cash flow. Since its inception, it's had 2 stock splits, a 2-for-1 and a 3-for-1, which is why the stock is currently only trading at $39.25 because of these multiple stock splits. If we check out the dividend, it's currently paying a 13-cent dividend per share, and this dividend has grown, and you can see that growth. And that growth has been going on since 1995. Looking at the financials, you can see that explosion in revenue where it was only at $23.8 billion to $26.5 billion, and that profit margin has also continued to grow, where the gross profit is $6.6 billion compared to $5.7 billion in 2017. Looking at that cash flow, you can see that the free cash flow has also grown since 2017 to $1.5 billion, so there's plenty of room to pay a healthy dividend. And we can see out of the 10 analysts that cover the stock, 6 of them have a buy rating, and 1 of them has given it a strong buy rating. So let's go ahead and add this to my portfolio. Time to open a position in Empire, EMP.A, trading right now at $38.62 and up 75% in the last 5 years. The yield is 1.32%, again a very healthy dividend grower. Has a market cap of $10.3 billion. New position, 1 purchase. Let's buy EMP. Done. The 4th stock on the list is Brookfield Asset Management. This is going to be another core holding for me. It's a great diversified portfolio of operations. It's one of the world's leading asset managers. Brookfield Asset Management manages subsidiaries in real estate, infrastructure, renewables, debt, insurance, and private equity. So with just one holding, you get exposure to multiple industries. The other thing I like about Brookfield is that it's a diversified financial business and it's not considered to be a bank. So you can hold a bank and Brookfield and get different exposures. It's currently trading at $57.31, a market cap of $86 billion, and a dividend yield of 1.16%. You can see that over its lifespan, it has grown over 2,200%, and it's paid a great dividend all the way since 1995, and it continues to pay a great dividend even today. In the last 1 year, it's up 53%. It has a slightly negative profit margin and an operating margin of 15%. It has a yield of 0.85%, that's an annual trailing yield. It has revenue of $62.67 billion. Revenue seemed to be down on a year-over-year basis, and the quarterly earnings were also down 24%. We'll look into the details when we get to the financial statements. It's currently paying a dividend of 16.3 cents per share, and this dividend has also grown over time. And as we saw before, it has a stock split. It actually has had multiple stock splits since 2004. 6 different stock splits. If we look at the financials, in 2017, revenues were $40.8 billion, and they had grown to $67.8 billion. We can see a decline at $62.7 billion, and because of COVID-19, there have been a lot of restrictions for businesses, and I'm sure once those restrictions are lifted, Brookfield will once again be growing, and I'm sure we're going to rocket past the $67 billion in revenue. Looking at the cash flow, we can see that it has a growing free cash flow from $2.3 billion to $3.3 billion, and it has grown its dividends along the way. So let's go ahead and add this to my portfolio. Time for our fourth purchase, Brookfield Asset Management, BAM.A. This one's up 94% the past 5 years, currently trading at $57.10, has a yield of 1.13%, and a market cap of $88 billion. We're going to go ahead and buy 1 share of this to open our new position. Let's go ahead and buy BAM. Done. That's 4 down. The next stock I'm adding is Atco. Atco, to me, is another great diversification play because not only do you get exposure to clean energy through its subsidiary Canadian Utilities, but you also get exposure to infrastructure investments, construction operations, as well as pipeline segments. It has businesses across North America, businesses in Australia, Mexico, and the UK. So Atco is currently trading at $41.39, a market cap of less than $5 billion, a PE ratio of 18.79, and it has a yield of 4.36%. So you can see in the last 5 years, the price has been up or down, but during that time, it has paid a healthy and growing dividend, where in 2016, it was 28.5 cents in 2016, all the way to 43.5 cents in December of 2020. So you can see that growth for dividends is there. Profit margin of 6.39% and an operating margin of 25.89%. It has a payout ratio of 73%, so it still has a lot of room for reinvestment in operations or for continued growth in dividends. It has revenue of almost $4 billion, and it seemed it faced a decline of revenue year over year at just under 11%. And quarterly earnings growth were also down 20.5%. Looking at some historical data, looking at the dividends, 44.8 cents as of March, so we had another increase going from December to March. If we go back in time, it's been paying its dividends since 1995, where it was 2 cents. So 2 cents in 1995 to almost 45 cents in 2021. It's 25 years of growth. It has 2 stock splits as well from 2005 and 2013. Taking a look at the financials, so total revenue of $4.5 billion and 2009 $4.7 billion. So steady growth. And typically with regular utilities, because a lot of these prices are fixed, you're going to see steady and predictable growth. The profit margin also, again, steady and predictable. Cash flow, a healthy free cash flow, and we can see the dividends have continued to grow during that time. And that's why I like the Canadian utilities, because based on which utility you're investing in, you can get worldwide exposure and you get stable and consistent growth. You're not going to get rocket growth like a tech company, but you get that predictability. So let's go ahead and add this to my portfolio. Time to open up a position in Atco, and I want the one on the TSX, trading right now for $41.43. And this one's up roughly about 7% the last 5 years. However, this one has a much healthier yield at 4.25% and a market cap of just under $5 billion. New position, One share, you guys know the drill. Let's go ahead and buy Atco. Place order. Done. The last stock I want to add is ECN Capital. Whereas the other 5 stocks I chose, to me those are strong and great core holdings for any portfolio. Whereas ECN, for me, it's a flyer pick. So ECN was founded back in October 2016. It was a spin-off of Element Financial's equipment financing division, which resulted in 2 separate public entities. Since then, it has sold its US commercial and vendor finance business, and today it operates in 3 different divisions: a home lender business, a manufacturer home lender, and a payment services company. The reason why I chose ECN because it's a growing business where insiders own a large chunk of stock and continue to buy so on a regular basis. So right now, ECN is currently trading just under $8 per share. It has a market cap of less than $2 billion, a very small negative earnings per share, the yield at 1.53%. It has grown almost 140%, zooming past the COVID crash back in 2020. In the last year, it's seen tremendous growth at 130%. It's been paying a 1 cent per share dividend since late 2016, and since then it has grown to 2.5 to 3 cents as of March 2021. So there is some growth. Looking at the financials, we can see that revenue has definitely grown from 86 million all the way to 266 million. So you are getting that revenue growth, but that revenue growth is also causing a growth in profit, which is important. Looking at the cash flow, we can see that the cash flow has been up and down, where it's been negative, positive, and slightly negative cash flow. So we'll see. Again, this is a high flyer pick. To me, it's not a must-have holding in your portfolio, but we'll see how it does. So let's go ahead and add some shares. Let's go ahead and buy ECN with the remaining amount of funds I have available. And I'll just pick up until I can buy no more. Currently trading just below $8 a share, and it's up 126% in the last 5 years. Relatively small company of under $2 billion and a yield of 1.65%. Since I only have $44, let's see how much I can pick up. Keep going. I can get one more in. And I think that's about it. 5 shares. That will leave me about $5 left, and that'll be my last trade for the day. Let's go ahead and buy 5 shares of ECN. And that's it. I have less than $3 left in my account. So we can see the total portfolio value at just under $600. And I have 13 open positions. And this is very misleading. I'm not really up 77% the last month. That's only because I've dropped in this new amount as funding. So here is my portfolio. You can see that I started with nothing, and now I've built it up to 13 positions. And the goal is that once I have a good selection of stocks, instead of adding in new positions, I'll be adding to these existing positions. And so far, I'm pretty happy with this selection right here. Good list of dividend growers. So let's go ahead and update that spreadsheet. And before I update the spreadsheet, a quick shout out for those that have used my referral link to sign up for WealthSimple. As you can see, the referral reward has come in. I get $25. And if you open an account with $100 and use it for trading, you will also get a bonus $10. That's an instant 10% return. So if you have not signed up for WealthSimple, make sure you go ahead using the link in the description. Not only do you get to use WealthSimple to grow your portfolio, but you also get to support the channel, which I really do appreciate. Okay, let's go ahead and make this happen. Okay, now that I've updated my spreadsheet, I'll walk you guys through what it looks like. This is my live ticker feed where I have various ticker symbols that I've added to my portfolio, the number of shares, the current market prices, and the change on a daily basis. I can see the last trade time. So let me go ahead and refresh this data, and we'll see all this data automatically refreshes. So I'm up 12 cents for the day. And we can see the last trade times were coming in at just after 3 p.m. And I got to know which industries I'm investing in, the market cap, the volume for today, and the 52-week high and low. looking at my dividend tracker, which I have revamped, now I can see the ex-dividend date for my holdings, the dividend that they're paying, and when that dividend becomes payable. So I can see that as of April 1st, I can expect a 31-cent dividend from TELUS. After that, April 5th, 18 cents from Aecon, and so on and so forth. So to me, this is a neat little dividend calendar where I can forecast exactly how many dividends I can expect between now and at least until the end of April. And this pivot table shows me the schedule of dividends that I can expect. So I can see that BAM is a pair in February, whereas primarily the other stocks are March pairs. And I can expect Empire and TD to make a dividend in April. Taking this data, looking at my dividend income, I had zero dividend income in February. March, I'm expecting to earn $1.11. These dividends are based on the ex-dividend date, not the payout date. Right? As a CPA, I guess it's in my nature to see how much earnings I've accrued before the actual payout. So in March, I have accrued $1.11 of earnings, and in April, I can expect 92 cents. And then going back to this sheet, I can actually see the payout compared to when I've actually accrued the earnings. This is all my total activity, where everything I've deposited into the portfolio and all the trades I've made along the way. And here's some historical data. So let me refresh this if there's any changes. So I was at a loss in February, and that loss has seemed to grow as of March so far, although the percentage is down. And my market value pie, TD is actually my largest holding at 15%. And then I guess some of my smaller holdings are Aecon at 4%. And I'll be using this market value pie to see, where I should add to my portfolio. If I have a lot of exposure in one area, maybe I stop adding to it and then focus on another area. And this is a really cool chart. It's a cool waterfall chart where I can see a snapshot of all the increases and all the losses. So anything in blue is a gain. So for example, with Bitcoin, I can see I have $1.73 of gain. And with ATD, I've got a loss of $1.84. Overall, my portfolio is showing a loss of $2.68 because it's in the negative. So if I refresh this, right, it also changes in real time as the markets move up and down. So to me, this is a pretty cool snapshot of what's providing growth to your portfolio and what you're currently at a loss with. And then going back to my summary. So far I have 13 different holdings, 23 shares altogether. My book value is $580, and I'm currently down $2.62, where my market value is $577. And I can also see a snapshot of what makes up the largest chunk or the smallest chunk of my portfolio. And I currently have, I'm currently expecting $1.11 of dividends by the end of March. And a lot of these facts and figures are pretty much automated, so I don't really have to do anything to the snapshot. It just changes as time goes on. Right, so you can see numbers do change as once I hit refresh data because it's pulling in from the live ticker feed. And that's it for my portfolio update. 13 holdings, just under $600 in value. And the one thing I do want to highlight is that, you will have some reds in your portfolio, you will have some green. I also want to highlight the fact that as a long-term investor, my goal is to continue to add to this portfolio. So that way I'm not, phased by the ups and down swings, because the goal is to build a dividend growth portfolio. And I will continue to add to this periodically, document all my trades, and show you the update as it happens. I have links in the description below for various discounts and sign-up bonuses. So please make sure you take advantage of those offers. They also help support the channel so I can continue providing content like this. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know in the comments down below. And while you're at it, make sure you hit that like and subscribe button. That's it for now. I'll catch you guys in the next one.